Have you ever wondered why money exists, or how banks actually create it? Today, we're diving deep into money and credit Class 10 economics, in a way that's simple, visual, and easy to remember. By the end of this video, you'll not only understand money and credit, but also impress your teachers in exams. Let's start with the basics. What is money? Money is anything that is widely accepted as a medium of exchange for goods and services. In other words, money allows us to trade efficiently, compare value, and save for the future. Without it, we'd have to rely on barter. Imagine trading goats for pencils. Money has four main functions. 1. Medium of exchange. It helps buy goods and services easily. Example, paying $5 for a burger instead of trading a notebook. 2. Measure of value. A money helps compare prices. Example, a laptop costs more than a pen. 3. Store of value. A money keeps its value over time. You can save it for future use. 4. Standard of deferred payment. A money allows credit. You can borrow today and repay later in the same currency. Quick retention trick. Remember it as MMSS. Medium, measure, store, standard. Money has evolved over time. There are mainly three types. 1. Commodity money. Objects with intrinsic value. Gold, silver, salt. Example, ancient traders used gold coins. 2. Fiat money. Legal tender declared by governments. Example, modern paper notes and coins. 3. Commercial bank money / deposit money. A money exists in bank accounts used digitally. Example, online transfers, debit cards. Retention tip. Commodity equals tangible value. Fiat equals government says so. Bank equals mostly digital. Now let's talk credit. Credit is the ability to borrow money from a bank or lender and repay it later. Credit is essential because it helps individuals, businesses, and even governments to manage their finances efficiently. For example, do you buy a laptop on a credit card? The bank pays the store immediately. Do you repay the bank later? Credit can be classified into two main types. 1. Short-term credit, usually less than a year, used for daily needs or business working capital. Example, borrowing $500 to buy inventory. 2. Long-term credit, more than a year, used for major investments. Example, housing loans, machinery loans. Credit can come from formal and informal sources. Retention trick. Formal equals regulated, safe. Informal equals quick, risky. Advantages. Helps meet urgent needs. Promotes business growth. Encourages saving and planning. Risks. Overspending and debt trap. High interest rates can increase repayment. Mismanagement can ruin creditworthiness. Quick tip. Only borrow what you can repay, and always read the fine print. Money and credit are not just personal tools. They drive the entire economy. Banks lend money, businesses invest, jobs are created, people spend, economy grows. Retention phrase. Credit is the fuel. Money is the engine. Imagine a student wants to start a small online business but doesn't have enough savings. They take a small bank loan, credit, buy supplies, sell products, repay the bank, and earn a profit. That's money and credit in action. Smart borrowing fuels success. Let's summarize. 1. Money is a medium of exchange, a measure of value, a store of value, and a standard of deferred payment. 2. Types: commodity, fiat, bank money. 3. Credit lets you borrow money for short-term or long-term needs. 4. Sources: formal and informal. 5. Always use credit wisely to avoid risks. Retention tip on-screen mnemonic. MCBCFR: money, credit, banks, functions, risks. If this video helped you finally understand money and credit, hit like, subscribe, and turn on the bell for more simple and visual Class 10 economics lessons. Comment below, which type of credit would you choose for a business? Let's discuss.